My name is Farhan. Today you will solve question number 8 from 2013 past exam. In this question, you will prepare the adjusting entries, close the revenue and expense accounts at the end of the reporting period. You'll also prepare the capital account and the income statement. You can get to see the workings on the right hand side of your screen, and on the left hand side you can get to see the question. Let's get started. Garden Gadget sells gardening equipment. The business prepares reports annually on 30 June. The following pre-adjusted trial balance was prepared on 30 June 2013. So we are given the pre-adjusted trial balance, and we're also given some additional information which we need to incorporate in our workings and prepare the journal entries to record whatever necessary adjustments and corrections are required. So a few terminologies have changed, which you can see within the pre-adjustment trial balance. In the old curriculum, we used to refer accounts payable as creditors control. So accounts payable are the credit suppliers of the business. So creditors control within the pre-adjusted trial balance refers to accounts payable. Then we have debtors control, who are the same as accounts receivable. So these are the current assets of the business. These are the credit customers of the business. Then we have stock control, which is what we now refer to as inventory. And then we have prepaid sales revenue, which is what we now call unearned sales revenue. So let's start with the first additional information that we're given. So on 30 June 2013, the accountant noted the following. On 1 June 2013, a customer, Rob Smith, paid a deposit of $1,000 for a ride-on lawnmower with a selling price of $5,000 plus GST and cost price of $3,000 plus GST. The lawnmower was delivered to the customer on 29 June 2013. Right, so let's start with what happened to begin with. So on 1st of June 2013, we have got a transaction and we received funds for inventory that we are supposed to deliver later at the end of the month. This is what we classify as unearned sales revenue, which is a current liability of the business, which is also known as revenue received in advance. So you haven't really delivered the item or provided the relevant service, but you took some cash or some money for it. So what's happening is that if we were to journalize this on 1 June 2013, we would debit bank by $1,000 to reflect that we have got $1,000 in funds into the bank account. And then we will credit unearned sales revenue by $1,000. So you need to mention unearned specifically because this is the thing that makes the whole thing a current liability. This is a present obligation of the business on 1 June 2013 after the transaction is done, where the business is obligated to deliver the item at the end of the month on 29 June 2013. So what happened when the business delivered this item? So once the business has delivered this item, the unearned sales revenue will now become earned as sales, which means the business has to reduce the current liabilities it originally had on 1 June 2013 for unearned revenue. So if the current liabilities now have to be reduced, we have to debit it to reflect that reduction because liabilities by default are credited. So when they increase, we credit them, and when they decrease, we debit them. So that is why we are debiting unearned sales revenue by $1,000 to reflect the reduction in current liability because the inventory has been delivered. And then we're realizing this as sales that we have actually earned. All right, so when we have sales, it's always credit. Whenever we have revenue, it's always credit. So you credit sales by 1,000, which simply means that now you deserve this sales, you have actually earned it. So once you know what journal entries to prepare, what I need you to do is immediately make the adjustments within the pre-adjusted trial balance that we're provided. That way you don't forget any of the things during exam. So if we are debiting unearned sales revenue by 1,000, which means reduce the current liability by 1,000. So here you can see prepaid sales revenue by 1,000. So we have to reduce it by 1,000. So that's why we are subtracting 1,000. And then we have earned this sales. So to the original amount that we're given here, we're adding an extra $1,000 to reflect an increase in the revenues that we have earned. Now, let's check the outline that we are given for doing the journal entry. So you can see we are given two different sections here for general ledger and subsidiary ledger. So general ledger simply records the assets, liabilities, equity, expenses, income. So general ledger should have accounts for all this. But what about the subsidiary ledger? So let me give you an example. Let's say we have the account for accounts receivable, who are the credit customers of the business in the general ledger. So the accounts receivable account that we have in the general ledger is going to record a summary of all the transactions that we have done with all the credit customers of the business. So within the accounts receivable ledger account, you can get to see the total for credit sales that we have made to all the customers, the total we have collected in cash from all customers, the total bad debts that we have written off, the total discounts that we have given to our customers, and the total returns that we have received from our customers. But what about the subsidiary ledger? The subsidiary ledger is going to have a detailed record of each customer that we have done business with. So let's just say we have 3 credit customers in total. All those numbers will be combined and reported within the accounts receivable ledger account that goes into the general ledger. But in the subsidiary ledger, we will have different accounts for customer 1, different accounts for customer 2, and a different account for customer 3. So each of these 3 different accounts will have the relevant transactions we have done with each of these customers. So that is the only difference. So this difference only works if you are working with accounts receivable and accounts payable, which is not what we will see in this question. So everything that we journalize will be going into the general ledger, which records the general assets, liabilities, equity, income, and expenses. So let's prepare this at the end of the reporting period, which is 30 June. So on 30 June, we are debiting unearned sales revenue, which reflects a reduction in current liabilities. And we are crediting sales because this is reflecting an increase in revenues that we have earned during the financial year. All right, so let's move to the second additional information now. On 13 June 2012, a cash payment for wages of $3,100 included $1,400 for wages owing from June 2012. The full amount of $3,100 had been recorded in the wages column of the cash payments journal. Right. So what this means is that the amount for wages expense of $48,000 that we are given, this has included the full $3,100. So what do we have to do here? So on 13 June 2012, we made a payment, $1,400 for wages, which were from June 2012. Okay, so wages from June 2012 are not consumed or incurred in the current financial year, which started 1 July 2012 and ended 30 June 2013. So we are working with a business that reports annually. And the most recent financial period, based on this question, starts 1 July 2012 and ends 30 June 2013. What happened was that during this financial period, we paid $1,400 for wages that were incurred in June 2012, which is prior to 1 June 2012 and therefore falls in the previous financial period. Therefore, this number is not relevant to calculations for the current financial period because this is an expense and this would have been closed last year. So what we have to do to fix this? So we debit the accrued wages by $1,400, which reflects a reduction in current liabilities and also the fact that we have paid the wages in cash. And then we are crediting wages expense by $1,400 because within the amount that's reported for the current period of $48,000 that you can see in the pre-adjusted trial balance, we have $1,400 included, which doesn't relate to wages consumed or incurred in the current financial year, but in the previous financial year. So we have to remove that effect. And when we credit wages expense by $1,400, we are basically saying that we're decreasing wages expense by $1,400. So that is why within the pre-adjusted trial balance, You can see for accrued wages, I've subtracted 1400, which is because we're reducing the current liabilities for payments that have already been made. And then for wages expense, I'm also decreasing 1400, which reflects the fact that we're decreasing the wages because this $1,400 is not relevant to the current financial period, but the previous financial period. So let's record this in the general ledger for 30 June. So we debit accrued wages by 1400 and we credit wages expense by 1400. All right, so let's move to the third additional information. The owner had taken one lawnmower for personal use on 15 June 2013. This lawnmower costs $300 plus GST and sells for $500 plus GST. No entry had been made to record this transaction. All right, so because the question explicitly mentions personal use, we understand straight away that this is referring to drawings that have been made during the period. So the drawings should always be recorded at the cost value, which is $300, because this is personal use. We are not in the intention to make any form of profit because we are using this for personal reasons. So whatever GST we would have paid on this inventory would be irrelevant for business purposes because now this is purely personal. And this also is valid based on the entity assumption, the accounting concept, which says that only business transactions that are relevant should actually be kept in the books. Everything that is not relevant to the business or doesn't help the business achieve its growth or profit or any objectives, that's not valid under the entity assumption. So this is why the drawings of $300 is simply personal. And how do we record this in the books? We debit drawings by $300. And we credit inventory by $300. Now, when we credit inventory by $300, we are just simply saying that because we have withdrawn inventory worth $300, our assets are going down, and when assets go down, we credit them. When we debit drawings by $300, we are saying that the owner's equity or capital has gone down. Always remember, capital by default is a credit account, which means when capital increases, we credit it. But when capital decreases, what do? We have to debit it. And drawings reflects a reduction in owner's equity or capital. Therefore, to reflect that decrease, we're debiting drawings by 300. So before we move to the outline that we're given, we have to make this adjustment in the trial balance that we're given. So debit drawings by 300 means drawings are increasing by 300. So we're adding 300 here to the original amount. And then we are crediting inventory by 300. So we are given stock control, which is what we call inventory. So it was 34,250 given here. So we are subtracting 300. Right. So now let's use them in the outline that we're given. So drawings debit 300 and inventory credit 300. All right. So let's move to the last information that we're given. The stock take on 30 June 2013 showed $34,500 stock on hand. So this simply means that we did a physical count one by one and we found $34,500 worth of stock on hand or inventory on hand. Now, based on what we have in terms of calculations from the trial balance, we originally had $34,250 in inventory. And then, based on the previous information, which we adjusted, we are subtracting $300 because of the drawings that we have made. So when you subtract 300 from 34,250, you should get $33,950 as the inventory we should have in the books based on calculations. Okay? So check the workings on the right-hand side of the screen. So 33,950 as per our calculations, but based on a physical count, it's $34,500. So physical count is obviously more logical and correct in this sense. So what we have to do, so we have to increase our inventory value by the difference of 34,500 and 33,950, which is 550, which we have to add to our inventory value. And if we are adding this to our inventory value, this simply means our assets are going up. Therefore, if assets go up, we debit it, and we debit inventory by 550. At the same time, this is a gain. Any gain is always credited. Any profit and disposal, any gain, any revenue, they're always credited. So because this gain is specific to inventory, we call it inventory gain, and we are crediting inventory gain by 550, which reflects an increase in total income, and debiting inventory by 550 here reflects an increase in total current assets. So let's just put them here in the working space. So debit inventory by 550, excuse me, and we credit inventory gain by 550. All right, so I believe you're all good to go with the first part. Now let's move to the second part of the question, which is part B. So part B asked us to prepare the journal entries to close the expense accounts at 30 June 2013. Right. So this should be pretty straightforward. So when you close expense accounts, which are the temporary accounts of the business, and the reason we close these accounts is because of the accrual basis accounting concept, which calculates profit based on the difference between revenues earned and expenses incurred. You debit the profit and loss summary always, and you credit all the expenses. So this is exactly how you close it. So you can memorize this. So what do we have to do first? We have to look for each and every expense after any adjustments have been done from the trial balance and include them here. So what's the first expense we got from the trial balance? It's the buying expense of $1,000, which is what you can see the third row. All right, so I've written E next to anything that is an expense, just so you can easily identify them. So buying expenses of $1,000, which we are crediting. Then we are crediting cost of sales by $123,820. Then we are crediting other expenses by $29,500. And then we are crediting wages expense by $48,000. Sorry, not 48,000. It should be 48,000 minus 1,400, which is the adjustment that we have made based on information number 2. Okay, so buying expenses of 1,000, cost of sales credited 123,820, other expenses 29,500, wages expense credit by 46,600, which was calculated by subtracting 1,400 in wages for previous period from the $48,000 balance that we're given in the pre-adjusted trial balance. Okay. And once you find the total of everything here for all expenses, that should be $200,920, which is what you're closing with the profit and loss summary. Okay. Now, the next requirement of the question in part C is to prepare the capital account. But to prepare the capital account, we also need to close the revenue accounts. So let's do that as well. We have two types of revenue. We have the inventory gain, which I believe you haven't forgotten from the last information that we worked with, and that's $550. The reason we are debiting all these revenues and crediting profit and loss summary, because that's how it is. So if you want to close the revenue accounts, you debit all the revenue items. That's how you're closing it, by offsetting it against what you would normally do for it, which is what you would have done, which is crediting it, right? But because now you're closing it, you just have to simply debit them. So debit inventory gain 550, debit sales 279,650. 279,650 was after the adjustment, the original value being 278,650 plus an additional 1,000. And credit profit and loss summary with the total of everything on the debit side, which is 280,200. All right. So obviously, if you just have a look, you can easily see that the total revenues were definitely higher than total expenses. Right. So total revenues were $280,200 and total expenses were $200,920. So if I was to find the net profit, which is simply subtracting the total expenses from total revenue, so $280,200 minus $200,920 gives us $79,280 as the net profit. So if we have net profit and we want to report this within the capital ledger account, where should we do it? So let's go and check that out. So all right, I think we are given the closing balance. Yeah, so the closing balance of the capital account, but this was the closing balance at 30 June 2013. Let me just verify something quickly. So capital of $252,000. Yeah, that's correct. So that's essentially the opening balance, I would say. So prior to any adjustments. So we start with the opening balance on the credit side, because if you are preparing the capital ledger account, it should always have an opening balance on the credit side of the ledger account. And when capital goes up, we credit it. So this is the credit side and this is the debit side. I believe you know that. Then we are adding the net profit that we have calculated of $79,280. So we have to write profit and loss summary here because we close the revenue and expense accounts against the profit and loss summary account. You cannot write net profit here. They will give you a zero if you write that. So just write profit and loss summary and 79,280. Why is this included on the credit side though? This is because we had a profit. What if we had a loss? If we had a loss, rationally, that would have reduced your owner's equity, right? So if your owner's equity or capital goes down, to reflect that reduction, you would be including that on the debit side. So always remember, if you have profit, you are putting it on the credit side because that increases the total capital that you have available for reinvestment purposes. And then if you have a loss, you just show it on the debit side, which shows that your owner's capital or owner's equity have gone down, which is not the case in this case, just so you remember in exam if you have a different question. Then on the debit side, we're including drawings at end of 30 June 2013. We had a whole discussion on why this is on the debit side before, simply because this reduces owner's equity, and that is $43,100. So this $43,100 is after the adjustment that we have made for personal inventory drawings, worth $300. So let's check the pre-adjusted trial balance that we are given. So you can see drawings of $42,800, which we originally had. Then we added an extra $300 because of the personal use withdrawal that we have made. And that makes it $43,100. Okay. All right. So we have one more thing, I believe. By the way, for part C, we don't have to close the capital account with the closing balances and carry forward the opening balance into the next period because the question asked us not to do it. We are not required to balance the account, but you can do it and you won't be getting any marks. So part D is to prepare an extract of the classified income statement for the year ended 30 June 2013 up to and including the adjusted gross profit. Right. So I've just done something very rough on the right hand side. So I don't have the title and everything there, which is what you will normally have in the outline. So I'm just going to quickly explain you what we have done. So obviously everyone knows the basic income statement format. So we start with the revenue, which is the sales, and that's 279,650 based on our adjusted calculations from the additional 1,000 with the old 270 and 650. Then we are subtracting cost of goods sold, and the cost of sales is 123,820, which is taken from the pre-adjusted trial balance, as you can see. Then I'm including buying expenses. Now, buying expenses is a part of cost of goods sold because they were very specific. Buying. So buying here simply means that it's part of your purchase of inventory from your suppliers. And it's more relevant, including this within the cost of goods sold, because it is essentially a part of cost of goods sold. So buying expenses of $1,000. So that makes the total cost of goods sold to be $124,820. Now, if you subtract the cost of goods sold from the revenue, you get gross profit, which is $154,830. And then we are adding any other income or other gain or other revenue that the business has. In our case, we have inventory gain of $550, where you could also have profit on disposal of non-current asset. You could also have discount revenue, which is the income that you receive by paying less to your suppliers. Right, so once you add the inventory gain to the gross profit, you get the total of $155,380, which is the adjusted gross profit. So that's it. That's exactly how you get full marks in exam. I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel, and post any of the topics you need me to cover in the comments down below. Also, if you need tutoring sessions, make sure to check the link in the description to book a call with me. I'll see you in the next video.